you so much for inviting me to speak at this inaugural event. And I was stepping back and thinking about if I would start working on structural transformation right now, what would it be? And this is, you don't even know where to start, given that this is going to be, the biggest crisis since the Great Depression, and countries are going to have to figure out how to get out of the hole that's been dug. But again, I think there are very important questions to be asked about how this, what would be the next stage, what would development look like in low-income countries. So I'm, given how much of time I've been spending thinking about COVID-19, the crisis that we call the Great Lockdown, I spoke to Joe, and Joe said that it would be perfectly fine if I talked about what's happening, what this crisis implies for low-income countries. And so that's what I am going to do. And I will leave the much harder questions of structural transformation and medium long-term growth to you, all of you, who are going to be a much better place to do this. Okay, so let me share my screen so I can show you my slides. Right. There. Okay, so I gave you the spiel. So before I get into the COVID-19 period, I thought we can start with the before COVID-19 to just remind ourselves of where low-income countries were in terms of growth. And so this is my first graph. So if you look at the period, about a decade from 2008 to 2019, and if you look at, on average, which is the black line, you can see a growth rate of about 5%. Now, population growth rates also tend to be higher, and so in per capita terms, it's a lower number, but still, a 5% growth rate is a very healthy growth rate. Now, an important feature of this growth rate is the heterogeneity between fuel exporters and those that are not fuel exporters, so the ones that are more diversified. And as you can see, the dotted black line, that's the growth rate for countries that are not fuel exporters, rely much more on a diversified set of exports. This includes countries like Ethiopia. But then you also have the red line, which are the fuel exporters, which are the low-income countries that are big major commodity exporters, and their growth relies very heavily on the commodity cycle. And you see the collapse that happened in 14-15 in commodity prices had a big impact on their growth, with growth in the negative domain, which means in per capita terms even worse, leading them to diverge in terms of economic health from the rest of the countries. And what you saw, and then there's been a slow recovery after that. So we were in the cycle when we started seeing a recovery. And a second big feature that I wanted to flag before going into the COVID period is the debt situation in low-income countries. So if you look at, this is a chart that tells you the evolution of risk of debt distress in low-income countries. And what you can see, for instance, just before the crisis, about half of low-income countries were either in debt distress or in high risk of being in debt distress. So these are the conditions that, the initial conditions you can think of for these large group of countries, which is for several commodity exporters who had been hit by the commodity price collapse of 2014-15, in a recovery, somewhat recovering phase, but still a weak recovery. And you have the very high levels of debt distress in a large number of countries. And now you have COVID-19. I guess you should not say after, but it's just COVID-19. It's not over yet. But we are now hit with this massive health shock. And this was, of course, a perfect storm with three simultaneous shocks, at least at the minimum: the global health shock, the external financing shock, and major shock to commodity prices. Of course, now I'm not including the fact that because everyone in the world is such a global crisis, that everybody in the world has taken a big hit to their growth, and demand has fallen across the board. That obviously this means that there's a big shock to their external demand, especially if you're a major exporter. But again, you have the global health shock, you have the external financing shock, you have the commodity price shock. So let's just go into each of these. And again, to think about structural transformation and growth for low-income countries, I think the question is to ask is, how persistent are these shocks going to be? Is this going to be a crisis where you have a deep recession and then a quick rebound, or is this likely to last for a very long time? And I think, unfortunately, I'm afraid that the answer is more on the negative side, which is that this is going to be a long-lasting impact, have a very long-lasting impact on the level of economic activity for sure. Okay, so in terms of the global health shock, so these are pictures that I'm sure everybody has stared at now for many months. On the left-hand side, you see this is the cumulative COVID-19 confirmed cases. So you can see on the left that we have, of course, had many countries that had very high levels of these cases. China was the original epicenter, moved on to then Italy, then to the US. And there's been some flattening. So there's been some containment and there's been some flattening, but still the number of cases still are high. In the low-income countries, you have, which is the figure on the right, this came with a lag. In terms of the health shock, you see cases going up, but again, the numbers are of a lower magnitude than what you see, for instance, for the rest of the world, the left chart. And so we've been trying to figure out, what is this? Well, what is there a good explanation for why this picture looks the way it does for LICS? Is it just that it's good luck so far, and then things are going to get much worse in the next weeks? Or is it about the fact that there are younger demographics in many of these countries? Or is it about pre-existing immunities from other kinds of diseases that are helping? And then, I mean, I think the bottom line from talking to virologists and public health officials is really, nobody will tell you that they know the answer to this. Nobody will tell you, yes, it's this and it's not that. Of course, another possibility is just of measurement, which is that this is not being measured accurately. But again, I think it's some combination of being unmeasured, good luck, better demographics, a plethora of possibilities, but it's not as if people have nailed exactly why this looks much better at this point. So one has to still prepare for the worst, and it's especially given that these countries have much weaker health capacities, the shock could be much more severe. Now, while the number of cases came a little late to the low-income country area, many of these countries responded the same way that other parts of the world did, in anticipation, as a precautionary measure to put lockdowns across, within their countries. And so this is the Oxford Stringent Index, and you can see that you have pretty severe levels of lockdowns, for instance, in Kenya, Ethiopia, and Vietnam. But again, so this is, regardless of the health shock, these kinds of lockdowns had an immediate effect on economic activity. And for many parts of the world, they've moved towards a reopening stage. So this is a survey that we do. We ask our membership, have any of the previously introduced mitigation measures been removed or relaxed? As you can see, for the advanced economies as a whole, pretty much everyone now is in the phase of reopening. And of course, at different degrees, it's not all reopening at the same pace, but they're in the phase 2, though we call the second phase, where countries are in different stages of reopening. You can see emerging markets too, about 70% of them are reopening stages. In low-income countries, on the other hand, they're only 50% of them. So they're still in the a big chunk of them are still in the first phase of the crisis with severe lockdowns, and then there's opening happening, but not in as many countries as we've seen. Now, again, these pictures change on a daily basis, so I'm sure if I had a day or two, maybe this picture would look quite different, so we have to be careful. But this is where they are in terms of the health shock, the lockdown, and the reopening. The second is the external financing shock. So we know there's been large capital outflows for many emerging markets. Now, I don't want to exaggerate this, because low-income countries, while they've integrated into the world, so there are some frontier markets that rely very heavily on external financing. But traditionally, low-income countries have relied on foreign direct investment, and they've relied on remittances. That's the right graph, and of course official lending. But again, what the left graph shows you is that if you look at portfolio flows to EMs and LICs, it's just a smaller. You shouldn't read into the difference between EM and LICs here. It's just that the LICs have just small amounts of portfolio investments going in there. But again, just like the rest of the world has seen a relative stabilization of financial market conditions, if anything, an improvement in financial market conditions, that is being seen even in LICs and in emerging markets as a whole. So there is this more broader point about what some might worry about as a disconnect between the financial market and the real economy, and that is visible not just in the US or in Europe, but that is visible globally. And you can see, if you look at exchange rates, for instance, country currencies that depreciated severely have now since appreciated. So there's a much more positive looking outlook when you look at financial markets. Now, I think for low-income countries, a big challenge for them is what's happening with remittances. So you see here a much greater reliance on remittances in low-income countries. Those are the red bars. And you can compare that to the EM average, which is about 5%, or the AE average, which is pretty much close to 0%. And country by country, there's very high reliance. Tonga is about 40% of GDP. I mean, Nepal, close to 30% of GDP for all of these countries. Now, this is tied to the problem of migrant workers around the world who are in, besides the deep economic distress, but also in terms of their in terms of access to healthcare, in terms of access to just basic livelihood. I think this is a major phenomenon, and the question can be asked about how quickly will this correct itself. I mean, how likely is it that we'll go back to business as normal and remittances and migrant workers being hired and remittances being sent back? I think there's tremendous uncertainty there, because around the world you're seeing, usually when you have crises, you have a backlash against migrants, and though migrants serve a very valuable role in each of these economies, they face serious risks. So this could be a persistent shock. I mean, you saw that following the oil price collapse itself. You saw the impact of migrant workers being fairly persistent, but but this shock could make it even bigger. And especially in countries where migrant workers are working mostly in the hospitality sector, tourism, those sectors are going to be badly hit for a while, especially international tourism. So this is an important thing to keep in mind. And the third is the commodity price shock, which is what we see here on the left. For commodity exporters, big collapse in commodity prices following the drop in demand from the world as a whole, but because of the collapse in travel, but also because of disruptions in OPEC negotiations initially. Now there's been more stability and it's going up, but the numbers are still well below the pre-crisis value. And if you look at our projections for this year and next year, we expect it to stay at these kinds of levels of 35 to 45, around there. So this is a persistent shock. So I'm trying to list out all what I think are going to be persistent shocks to keep in mind when one is thinking about structural transformation and economic growth. And you see, and this is one of those. The right-hand side is agricultural commodity prices, which is, you see, on the other hand, you saw a sharp rise in in food prices, especially if you look at rice from the US. Again, compared to the pre-crisis levels, some of these food prices are elevated. Given that a large number of low-income countries are food importers, this can be this has a negative impact for them. So on the one hand, the commodity exporters have a negative impact that comes from a drop in oil prices, and food importers have a big hit coming from, I believe 23 out of 25 low-income countries in sub-Saharan Africa are big food importers. So this can have an effect on basic cost of living. Okay, so these countries have been hit by these three major shocks. On top of and then the question is, this is not, many countries around the world have been hit by multiple shocks. Of course, here the commodity price shock is a very major one. And countries around the world have responded very strongly with unprecedented measures, monetary policy and fiscal policy this time around. But you can see the constraints and how much low-income countries can do. So they're hit with very similar shocks. Their needed spending is of the same magnitude, but there's only that much they can do. So if you look at announced fiscal measures, for instance, in advanced economies, as a percentage of GDP, it's over 8%. Emerging markets, we're talking at about close to 3%, and low-income countries around 2%. So there are, to deal with, you have a shock of this kind, and this is again not so surprising, given that for many of these they rely on oil revenues, and with oil revenues collapsing, this can have a big strain on their fiscal spending. And this is again something to keep in mind when we're thinking about structural transformation and growth coming forward. The question is, where will the financing come from for this? How will the fiscal situation impact the path of growth going forward? The right-hand side chart shows you another very particular challenge that low-income countries face when they look at when they have to deal with this crisis. So this is a crisis that has required to put money very quickly into the hands of a very large number of workers around the workers. Now, if these are formal workers, it's much easier to get money into their hands. If they're informal workers, on the other hand, this can be a major challenge. And we've seen that we did a calculation. We have a paper, very nice paper, which does calculates, for instance, the fiscal cost of transfers to informal workers. This is region by region. The blue lines represent for the amount that's for low-income countries. The green is for low-income countries. And as you can see, just given the size of the informal sector being that much bigger in low-income countries, the size of the transfers have to be very large, very substantial. So a median fiscal cost of a 2-month transfer, which is to cover food and energy bills, to informal workers will be between 2.2 and 5.7% of GDP. So these are really substantial amounts. Okay, so that's where they are. Again, just to summarize, they started out with high levels of debt distress in many countries, weak growth from commodity price shocks. Some, of course, have did well, the more diversified. And then everybody was hit with a trifecta of health shock, financial shocks, and commodity price collapses for exporters, including a big drop in external demand. And what does that imply for growth prospects? Of course, so this is our WEO forecast from April. And you can see region by country, category by category, oil exporter, non-oil exporter, frontier markets, all of that you've seen a big downward revisions in growth. And this was done in April, so this is already, I think, optimistic. So we are revising this. We're going to come up with new numbers in June. But this is a common shock. Everybody's growth across the board is weaker at this point, projected to be weaker. So what are the key economic challenges? I better hurry up. I seem to be going slower than normal. So what are the key economic challenges? I would list 3. The one is for countries is the low level of diversification, as everybody knows here. They rely very heavily on tourism revenue, commodity export revenues, and just in terms of if you look at the balance of payments receipts, these are a very large share of these receipts. And so again, the question is going forward, how are you going to have the financing, the foreign currency, how will you have the foreign currency revenue to be able to pay for a lot of foreign currency imports that these countries need to make? Second, there's high informality and a digital divide, which is what I talked about earlier, which is the high levels of informality, which made it a real challenge to get money into the hands of workers, and a digital divide. Now, this crisis has been a boon for anybody who can work from home, and if you do not have the adequate amount of internet capacity, broadband networks, then you get hit particularly badly. And as you can see here, the delivery capacity, for instance, through mobile and or bank accounts is just that much lower in, again, region by region for low-income countries. So going forward, I think the world is going to probably kind of dig in on digital transformations. If LICs don't catch up fast enough, it can lead to further divergences. And then the third is this difficult cocktail where you have projected slow growth and you're going to have ever rising high debt. And so this is going to bring in, obviously, questions of need for debt restructuring, debt service moratoria, or debt service relief. All of those is going to come up, and this is not going to go away anytime soon. It's going to be there for a while. So looking to the future, I have my last couple of slides. Before I jump in, just into the future, let me just talk about the IMF's crisis response. IMF has moved very quickly to disburse a large amount of money to, at this point, actually over 60 developing countries, provide emergency financing, immediate debt relief to 27 of our poorest member countries. But then there's also been other efforts. There's the together with the World Bank, we are supporting the G20 debt service suspension initiative that could again make some 12 billion available to eligible low-income countries. And lastly, we're exploring ways to deploy SDRs to support low-income and small economies. So this is clearly a major, major priority for the IMF. Again, I think I think in the near term, there's debt vulnerabilities are going to remain a major concern, and this is going to require multilateral support. There's going to be need for continuous concessional financing, debt restructuring, debt relief. This is not going to go anytime soon. And there are huge, in one sense, you can think there is a huge opportunity, which is that if LICs can show that they are resilient to a crisis of this magnitude, then that can bring a lot of confidence to foreign investment, for instance, and this can become a much more attractive place to park money in. So my last slide were the big questions, I would say, for STEG work. I think these are the hard ones that I'm going to leave for you, which is, what does the structural agenda look like for LICs in the aftermath of the crisis? Where does this leave commodity exporting low-income countries? And how will this crisis change our thinking about climate change and automation and AI? So for the low-income countries, from a long-term medium, long-term perspective, these are crucial challenges, not even medium, even short-term perspective. Climate change and automation and AI are key challenges for low-income countries. So in terms of the structural agenda, the structural agenda has been, one has been about saying, okay, well, let's make agriculture more productive. I'm talking about this pre-COVID. Make agriculture much more productive. Manufacturing may not be so viable. Let's leapfrog to services directly. How do we do this? Do we do this with a very targeted industrial policy, or do we do this in a much more, horizontal manner, which is basically make sure you have the right amounts of input, so you have good education, good internet access, good infrastructure, so that the best can bloom. I think these questions are going to come up, and the question is, what will finance any transformation? What is this crisis going to do? How is this crisis going to change tourism on a permanent basis? I think on climate change, there is very clearly a push in advanced economies to take this head on, and to recognize that nature can be brutal. And so this is not going to be the last crisis from a natural disaster of any kind. It's going to be many, there can be others, and it could be even worse. And so maybe this is the positive, which is that their actions should help, obviously, the costs that LICs face because of the policies in the advanced economies. And so that could be a plus. But even within LICs, you could make a very good argument for cutting back on energy subsidies at a time when energy prices are so low. And a lot of these energy subsidies are distorted. They are not very efficient. And then there is, I think, the another one is on automation. Here, I think it's going to be very hard because this is a crisis that certainly triggers a push towards more automation. And again, all of the questions about where will the jobs come from, what will the jobs of the future look like, how, is this going to be another lost decade for workers? I think these are all big questions. And again, I don't have any answers to them, but I can see, I look forward to great research work coming out on all and more of these issues. So with that, I'm going to stop. Thank you.
Okay.